Okay, traders, welcome back to the channel. Here we have the Nasdaq futures or the NQ chart in front of us, and we're going to be going over a very quick case study as to a potential trade you're going to be taken. We're going to be focusing on the concepts here, specifically on liquidity and timing. So two of the key aspects to ICT trading when it comes to futures, forex, indices, or whatever market you're looking at, right? When it comes to ICT, we often want to pair price with timing, and we're going to be looking at liquidity pools and pairing it with specific times of the day, right? So just before we get started into the video, I just want to say that at Liquid FX, we're offering 30% off all Liquid FX packages, so that's free one-to-one sessions with myself. That's the full PDF simplified ICT course. That's the opportunity to sit down with me and ask questions and go through my entire training. All of that is for now an extremely cheap 30% off the original cheap price. So if you're interested in that, please give it a shot. So now let's get back to the chart. So here we have the Nasdaq futures in front of us, or the NQ, and we're going to be dissecting price action here on the 15-minute chart, right? So what we have over here is we have price giving us the Asian range over here. So this is the Asian range over here. Asian range is typically in orange from the charts I've been looking at recently. So when we have the Asian range over here, right, this marks London's Asian range over here. This is Monday's Asian range, sorry. So here we have Monday the 25th of March, time of recording, just over a week ago. And we have the Asian range over here in orange, right? Now we have the Tuesday's Asian range over here, right? So what we're going to be going over is a liquidity-based and time-based specific price action techniques that you can apply to any market, not just NQ, but ES and the other markets, right? So here we have Monday's price action, right? That typically gave us that lower pricing over here, right? So we did have a bearish week overall, right? So Monday again started that bearish activity, right, by heading lower. So what we had over here is we had what I like to call a Monday manipulation, or simply a bearish manipulation like this. So Monday produced that low of the day over here, right? Monday produced the low down here, right, following basic structure over here. So what did Tuesday do, right? Tuesday is what we're going to be dissecting, right? So we understand we have Monday's liquidity over here to the left, and Monday's high of the day coincidentally aligns with the Asian high from Monday. So this is the Monday high over here. So this is not accidental, everyone. This is one of the key aspects to ICT trading, right? We need to understand that everything is based off keying off the next liquidity pool, keying off the next fair value gap, and targeting the next liquidity pool. That's very important to understand. So this red line over here represents what we call the previous day high, or simply the PDH, and it also aligns with what we call the Asian range high, so ARH, Asian range high. So these two specific metrics become very important when it comes to understanding the liquidity of the market and how we're actually moving, right? Because we've all heard the saying liquidity is everywhere, but we need to pair certain liquidity points with time, and here's how we do it, right? So coming into Tuesday, we understand we're primarily looking for sells, right? Because we understand that Monday was a bearish day. So Monday, we understand, was a bearish day, right? So quite often when you go and look at the indices market, the futures market, NQ, ES, S&P 500, even the Forex pairs like Euro dollar and pound dollar, the Tuesday will often continue on and give the same sort of a trend as Monday, unless there's a high volatile news event that perhaps sets that off, right? But Tuesday will very typically continue on the momentum from Monday, right? And at the moment, we're currently trading above a H4 high, right? A 4-hour old high. So currently we're in a situation like this where we're kind of up here like this, right? So we have the H4 old high up here, right? So this is the old high. And so above an old high, we expect a correction, right? So we're looking to sell, seeing somewhat of a correction before eventual higher prices. So we're looking to sell in this sort of region over here, right? This is exactly how the trade was planned out from the higher time frame. But here we're going over specific liquidity pools. So if I bring your attention now to Tuesday's price action, Tuesday again had the Asian range. Notice how we've swept the Asian range from Tuesday. So this is an Asian range sweep as well from Tuesday. And the Monday's previous day high in Asian range is also swept. So from here we understand we have a key pool of liquidity that's been swept. The Asian range high from the previous session, but also the previous day high, which coincides with the Asian range high. Perfect. So above this now, we're looking for that 2022 model or a simple shifter market structure to get involved. And here's how you can do it, right? Here's how this potential trade could have been played out, right? What we're looking for is we're looking for this. We're looking for a shift of market structure. Some people call it a chalk, but I prefer to call it a boss. So what we see over here is we see price giving a break of structure, right? And we see price keying off a fair value gap, and price actually keyed off a second fair value gap before entry. So we have two types of entries over here, right? We have or you could say a risk entry and a confirmation entry. So we have an aggressive entry and a more conservative entry. So what we have over here is we have the liquidity sweep. That's very important, right? This yellow box here denotes the liquidity sweep. So this particular liquidity sweep occurs during that London session post Asian session, right? So this here represents that Judas swing, and this Judas swing occurs in the London session, right? So this Judas swing here represents a key shift of market structure, right? And the shift of market structure occurs just like this. So we saw an intermediate term low here. We saw that high, that Judas swing London high sweeping liquidity over here before the shift of market structure, right? So now we need to understand we have two key points to look at when it comes to overall market structure and settlement direction, right? This here was a fair value gap over here. Fair value gaps are marked in dark blue. This fair value gap again, that London session, right? So now we have the 12:30. This is 12:30 UK time. Bearing in mind this is daylight savings in the New York, right? So this was actually the New York Open here. So this is going to be 8:30 Eastern time. Again, daylight savings. That's why there's an hour shift on UK time. So this was 8:30 Eastern that produced that first fair value gap over here, right? So this was again a respected fair value gap, right? So we understand price really respected that. Notice the wicks coming in, only the wicks came in over here. So we see a clear respect of the Eastern, the 8:30 Eastern open time fair value gap, right? So we saw a shift of market structure over here. So this was our first shift. And we saw a second shift over here, just like this, right? So this is our second shift of structure over here. So we're seeing this pattern play out, right? So we understand we have a Judas swing over here in yellow, and this Judas swing gave rise to a fair value gap. We're looking to key off either the first fair value gap, which was somewhere around here, right? This is the first fair value gap, but it's safer, in my opinion, to wait for that second fair value gap in the New York session before continuing lower, right? So this is where that potential fair value gap was. We have a fair value gap just over here at 2:15 UK time. So this here again corresponds to a time between 10 and 11 a.m. Eastern Standard Time, right? So this 10 to 11 Eastern Standard Time represents a very clear fair value gap for entry, right? So how do you enter? Very simple. You essentially key off the fair value gap. A safe stop loss will be just above these wicks, because notice there isn't any inefficient price action just above these wicks. You can have it above the Judas swing, a little bit more conservative. You can be a little bit more aggressive and have your stop loss just above the wicks that filled the previous inefficiencies over here. So as a trader, you want to ask yourself, where is the next liquidity pool to target? So we understand we've keyed off a time-based fair value gap, right? This is a time-based fair value gap. So where do you now want to enter? Where do you now want to exit? Well, you want to take something off the table just at the Asian range low over here, right? So this Asian range low over here is essentially that first pool of liquidity you want to take off, right? So you want to take something off at an Asian range low, which just happens to be over here. So this is the Asian range low, or simply the ARL, the Asian range low, which gives you an area to take something off, right? As you can see, we have a fair value gap over here, an inefficiency just over here to the left. This inefficiency also needs filling, right? So price eventually did, come down to the inefficiency, giving a 1 to 2 or a 1 to 2.5, right? So it's understanding that liquidity, fair value gaps, and timing all pair together to make an A plus entry on NASDAQ in this case, or in any other market that you choose to trade, right? So if you like this video, give it a like and thumbs up, and I look forward to seeing all of you in the next one.